While the US Federal Reserve, remains at a cautious tone, the interest rates are elevated somehow to, tame inflation, which it was the story with the previous year. In India, the story is a little different with now inflation under the target range. So now these divergent policy paths are creating unique opportunity sets, and of course risks with it across the yield curve. So today we'll unpack with us, what all this means for investors, whereon, investors could see the opportunity, particularly in the fixed income space, and what strategies could be looked at or, could be tapped into to reposition in this whole background. So over to you, Kruti. So first and foremost, I would actually like to ask you, since we are setting the backdrop in the whole, interest rate crossroads, and what is there for the Indian investment landscape here. So, just a second. Yeah. What influences the Fed's decision, or, for that matter, even the RBI decision? If you could just give us some insight on that.
So the answer remains standard for that. For any central bank, there are three factors that predominantly make their decision that which way they should be going. For India, there are two because India does not have an employment gauge as yet, which is official. But if you see for a central bank, the primary focus is on inflation and GDP. And then obviously as a subsidiary of it is obviously how the job market is, because if there are jobs then the GDP is doing well. So if you have to see on that front that as a central bank, if you're gauging that okay, your inflation is well within the target what you are estimating, because for any economy a moderate inflation is a sign that the economy is doing well, the circle of the economy is going well, your growth rate is on the base that you are developing is at a good rate. Then the decision of a central bank is that okay, let it be right now, whatever is going on, it is at a good pace. But if one of the balance also starts moving, then the central bank starts thinking that what decision should be the next. Now unfortunately for US, both the factors are going apart, they are not going in sync. Generally what happens is that your first the employment starts slowing down, so that we are already seeing in US by the job openings, that the employment is now the number of jobs that are getting available are reducing. Obviously the tariff was announced on the first week of the April. The April data does not completely capture the influence that the decision is going to have. It might more reflect in the May data. We'll speak more on the what the jobs data is showing also in detail. Second is that when the jobs go down, obviously people have less spending power. If there is a less spending power in the hands of the people, then likely your GDP will also go down. And because your GDP will go down, your central bank is likely to step in and say that no, we need to bring the rate back of the growth again in the economy. Because essentially for any economy, eventually you have to keep generating the revenue for that economy to keep running, right? It cannot go on a flattish, then the revenue for the economy goes away. Now, the problem with the Fed right now is that they are seeing that the economic growth is going to go down. They are seeing that there is going to be a slowdown in the GDP growth also. But at the same time, they are seeing that the inflation is going to go higher. Now, in a normal scenario, if the GDP growth is going down, your inflation would also go down because the demand for goods would go down. But this is the opposite case, that the inflation is going to come into the economy, and it is going to come into the economy not because there is demand for the goods. It is going to come higher because the tariffs are imposed and the cost of the goods are going to go higher. So it's a very dicey situation for Fed, and they have kept repeating that we will rely on the hard data to come, because there was a lot of fluctuation in the decisions. There were announcements every other day that were made in past 1 month. So rightly so, they are right now staying on the narrative that we will depend on the hard data and we will take decision based on the hard data. A couple of points, and to point out over here is that in the previous speeches, we have seen Fed members saying that inflation can be transitory in nature. So that means that Fed is also gauging that if this inflation is a one-time uptick, then they might have to concentrate on other factors. Another point that they pointed out was that if the inflation is higher in the goods and not in services, it says that the gauge that the economy is not going strong overall and the goods are only going up because of the tariffs. So that also is something that they have pointed out and said that they would be considering while making the decision. So therefore, we feel that this time, while Fed awaits the harder data, they have their eye on the other small details also as of now. So a tough one, and probably because the data is still developing, there would be a wait on watch at least the upcoming policy.
Right. So these three data points, the job openings, inflation, and GDP, which are on some are on a declining path. Actually, all of them are on a declining path, but for some it's positive decline, and for the decline is negative. Right. So just viewers, just one thing, if you have any questions, you can drop in the chat box, and we'll take it towards the end of the webinar. So, Kruti, this brings me to the next question. Now that we have established, okay, the decision making depends on so and so factors. Where could the needle drop? What could be the decision, for the upcoming meeting, which is today at the night at 12 o'clock Indian Standard Time? So, where could the needle drop? What it could be, rate pause, a rate hike, or a rate cut, as per, what the data says, what the market sentiment says. What is it?
The market sentiment and the general consensus is that there is going to be a rate pause. The majority stands over there. Narrative seems to be something that is to be looked out for. Probably they would point out the factors that, what they are looking at. One of the factors could be that the jobs data has come in good, but where have the jobs increased? So if we watch the quarter one GDP data, there is a drop in the GDP data, but that is also led by a lot of imports coming in, though that should have been reflected in the inventory, also balancing it out. But that has contracted more than the expectation that is there. Now, if we see the jobs data that has come in, there is an uptick in the health sector, which is more of a stagnant hiring, but there is a uptick in the transportation and there is uptick in the construction segment also, which could be one off. So there are these minor factors that one has to look out, and how much is Fed concentrating on these factors. Like in the previous policies and narratives, they have said that they would be looking at goods inflation rather than looking at the overall inflation to take the next decision. So market consensus seems to be on a pause because they have reiterated that hard data is something that they want to act on, and probably if the May data comes in weaker on the job trend, that is the first sign of the weakness that would come in. Then we will see that May there would be some other decision that would be coming in, but for tonight the data that is there, that would be somewhere around a pause and a narrative mostly saying that again it's on hard data that we would be seeing, and some of the minor other points that they would be looking at this point of time. Also, since you're sharing the screen, and this is one of the essential thing that we wanted to point out also, is that the Fed has increasingly since 2022 kept changing the decision based on the situation, and this is the two just one previous slide if you go on. So if you see on January, the market expectations were that Fed would probably at the year end would go at a 50 basis rate cut. Now the market expectation is that there would be probably 100 to 125 basis rate cut, and this is pure market expectation. If we move on to Fed's decision, Fed's dot plot also, which is every second meeting that they launch. There also, if we see the range has been wide, and by the lines you can see that in March 24 they expected that the rates would be around 4.5, 4.7. That has come down drastically by this year end of 2025. So there is a lot of variance that keeps happening with every situation that develops, and uh, not necessarily the dot plot that is given currently estimates what is going to likely to happen, though central banks major aim is to maintain financial stability and give a forward looking communication, but they seem to be in a tricky situation, and we cannot completely rely on the dot plot that has been given in every policy because they change policy by policy.
Right. So, with every policy announcement, so these dot plots, viewers, just for your information, comes on every alternate policy. So, in a very alternate policy, the dot plot keeps on shifting, and of course, it's dependent more on the data that they are seeing. So now, looking at home, is India independent of the, US Fed decision? And what is the yield relation? Do we get highly impacted by, say, any positive or negative movement of the US? GSEC yields, UST yields, US Treasury yields, or are we independent and so are our yields independent? What's the correlation sort of there?
To say that we would be completely independent would not be right, but the situation is different, is what I would say. Maybe in a longer run, we will again align to what the Fed says, but as of now, it is different, not because we are going different, because US is going completely different from the world economy, and which is why we are saying, seeing that not only India, but there are other central banks also which have taken the stance contrary to what the Fed has been taken. So for India, similarly, as of now, because the situation is such, the correlation has kind of been lost at the moment. Because if we see that Fed is looking at a higher inflation, a slower growth rate, but India is in a perfect situation and higher fiscal. That
Right.
is one of the main worries that they are, as a government, they are addressing, and the
Facing.
narrative is around that. But for India, it is a complete win-win situation with inflation expected to be in the target range and possibly at the lower end of the target range. GDP growth is expected to be on the moderate side. We are not expecting that the growth is going to be outstanding, but we still remain one of the fastest growing economy. And third is that we are seeing the fiscal prudence is there for last couple of years. We have maintained it, and we don't see any reason why we should be exceeding it this year also. Having said that, government is very cognizant of the capex and where they are spending also. Therefore, they have also in fiscal prudent, and within that they have maintained a guidelines that if there are higher allocations given to the states or the loans that are given to the states, that would be towards the capex rather than the other elements. So there is a very tight and stringent way that we are operating right now, which is maintaining the absolute macro stability in the economy.
Right. So fiscal prudence and inflation and target range has given RBI also the MPC also that space to have an accommodative stance, which is again working for India and which, like you are saying, is making us somewhat independent. Of course, not completely independent, but somewhat independent from the US impact. Sure. So, Kruti, what you would want to summarize here, before we move on to, what the investment landscape looks at, that, what could be expected tomorrow, from the US Fed and what impact finally on the world globally or on India one can see.
To summarize it very simply, we will not see a very different narrative than what we have seen. We will see a very neutral stance which will be taken, not commenting much on the government developments back in US or the tariffs, and maintaining that there would be wait and watch. There are escalations that have taken place between US and China, and we are not getting any close to negotiating. So that would eventually happen maybe, but as of now, because there is an uncertainty, there is a risk of indecisiveness, which is going to translate into the economic slowdown. And like it is largely believed that if in US sneezes, world catches the cold, there is going to be a slowdown globally all over. So and that is one reality that we have to face, that we will struggle to get to the estimated number of 6.4% in India. And if US, maybe if they remain in the positive growth rate, that would be a very good sign at the end of the year. uh, Fed, what they can do is right now maintain wait and watch on the hard data that comes in. But in the last policy, they have already announced on the quantitative easing, maybe more measures around that, so that they support the market, because the levels that at the longer end still remains higher. They still need to finance the 9 trillion of the debt this year with 1 trillion of coupon payments outflow every quarter. And if the supply is to go down and if there is uncertainty, there is going to be lack of demand, which they cannot afford at this point of time. So they need to bring out that middle ground. Probably we'll see the Fed balance sheet again building on the US Treasury, which they had built it back in, COVID times, 2022, 3, they were the highest on the US Treasuries. So all this probably a silent measures, but towards the easing. And when they finally see it in the data that there is a slowdown that is coming in, we will see that the acceleration of the action will be much faster than what market anticipates, is what we see from here on the domestic side. Like we pointed out, we are in a sweet spot. There will be a slowdown in India also. We cannot escape. It's a globalized world. Everyone is interconnected. We remain lower on inflation. The last year's production has been good. The monsoon is expected to be on a long-term average lines, or maybe more than long-term average lines. And third is that our reservoir levels is higher than the decadal high average that is there. So we stand pretty comfortable on the inflation. I would also like to add on inflation since last 2 years, because we've seen in a pattern that there has been, a lot of fluctuations in the vegetable prices, especially the top vegetable, that are tomato, onion, and potato. Now tomato has a shortest shelf life, so there is a very less that you can do on it. But on onion and potatoes, over the last 1 year, there are a lot of warehouses that have been built up to stock up, so that we can at least avoid the fluctuation in the prices of these two commodities, because the shelf life is higher. So we will see that less of the fluctuation will happen in these commodities also, which are the higher percentage of the inflation basket. So we stand pretty comfortable on the inflation with everything in line, and fiscal prudence, as we've seen, is maintained, and we don't see that government intends to, get disruptive on this anytime soon. With this, we see that RBI has set an entire base to take the growth to the next level. And when I say this, um, uh, the action has spoken much more than words on RBI, with around 8 lakh crores of the liquidity provided in the market in 1 quarter. Though OMOs have been given what were expected for the entire in the first quarter itself. So essentially, what this MPC has done, or this members of the committee has done, is it has set stage for the next level of the growth that India can go to. And I say this because in the minutes what we see, we have not seen the previous MPC commenting on the private capex picking up. In this MPC minutes, we see that the members are speaking about that the government capex can go this far. If you have to take it from here on, the private capex also has to go higher. So they're setting the entire base for the private capex to pick up from here, and that can only happen at attractive rate and increase consumption. The current capacity has to be utilized for that. So we see that this is a next step towards that, and probably they will stay on the course of the accommodation for the next leap of growth for India. And uh, as we've seen, the OMOs keep coming into the market. So the gap which was there because of the index inflows that we had last year is pretty much filled in by the RBI through OMOs also, and the domestic demand, which is the larger part of the GSEC, remains intact. So we see that that is also pretty much stable, and therefore we've seen that, in spite of all the turmoil that has happened in global markets, India yields have gone down with the domestic actions.
Right, right. And with forthcoming, monsoon season and currently the reservoir levels look adequate, the inflation could further also not go out of the target range. Thus, the accommodative stance could be continuing going forward. So then this brings us that, what are a few funds that, investors could be looking at, or if not funds, what categories they could be looking at? What makes sense to get into at this point in time? We have been saying from quite a while that, the interest rates were at its peak last year, but, with the rate cuts happening in India and also abroad, also in many places, what could be the next step for investors in the fixed income space?
So we started the year saying that it would be a shallow rate cut cycle, and the entire rate cut cycle would be 50 basis. That has been delivered in the first quarter. Advice to investors would be that when the things are in a certain positive momentum for the market, you don't fight the flow, right? You generally go with the flow. So when we are seeing that all the actions are being taken in that space, you don't run away for it from it. You invest in that because you know that there are further actions to be taken. Looking at that factor, that accommodation is likely to continue, and this is just the domestic part that yet has played out, right? We are yet to see the global part to be played out, so that will also play a separate booster for the fixed income markets when that plays out. So one is that factor. Now second is that if we are looking at a yield curve, two areas that we find entire fixed income would perform in this entire range of things, but two particular segments that we look at that looks very attractive at this point of time is that if you see the corporate bond yield curve, that has become in the shorter end it has come down slightly, and then longer end it has steepened, but in between it has become flattish. So there, the in the 3 to 5 year segment, there is an opportunity. We would see that entire yield curve will shift, but in order to steepen, the 3 and 5 year or 1 to 5 year is the yield curve which would have to like come down more faster than the longer end of the curve. So we see that that is a segment that one can look at particularly for investment if they're looking for the corporate bond segments or corporate bond plus GSEC segments. If one wants to play purely on the interest rate and sovereign bond with no other risk or whatsoever, then they can look at the category of long duration, because when there is a rate cut cycle that is going on, the maximum benefit that an individual gets is from the longer end of the GSEC curve. So anywhere where you're parking on the longer end of the curve, the risk is higher and the reward is also higher. But when you know that the likely benefits are to come and the stand stays, that would be a good play. And also right now the opportunity has opened up in the longer end of the curve, because if you see the spread between a 10-year to a 30-year is typically 25 basis points. It has opened up to 45 to 50 basis points right now. So there is a very good chance of the spreads narrowing over there and investors gaining more than the 10-year benchmark or the other typical index, which would be 8 to 13-year GSEC or 8 to 10-year GSEC, that would be there. But that is also obviously a longer end of the GSEC curve, and the risks are higher, but the rewards are higher. Given the situation, the risk reward, that is a segment that one should be looking at, and a 3 to 5 year is typically corporate bond segment that they should be looking at.
Sure. And what about the longer term, longer duration segment of the curve, or this category? What views you have on the same at this point in time?
A longer duration of the GSEC or the corporate bond?
No, 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 longer duration category of the mutual fund. Say, if someone is looking at some of the mutual fund categories to invest in, so what about the longer duration fund category in the mutual fund space?
At this point of time, when there is an accommodation and there is clear every action taken, the maximum benefit would be in the longer duration segment. And also, one thing that we should be, cognizant of is that because there is a because there is going to be a slowdown that is going to take place, the demand for the fixed income will also go higher. And it also means that in corporate bonds also, because not much of the expansion will take place, the supply will go lower. In GSEC category also, the supply has in the extreme longer end, the supply has been lower compared to the last 2 years. So out and out, there is every case for the longer end of the curve to perform in the due course of this rate cut cycle.
Sure. So the supply and demand dynamics, as well as to where the yields currently are, it makes a case for, like you said, longer duration of the curve, both in the corporate bonds and the GSEC part of the instruments. So with this, I'll end the screen share, and viewers, we are open to Q&A. So we'll take a second, a minute or two for you, for our viewers to write questions. Meanwhile, Kruti, just to summarize the entire thing, there's a question that everyone has in their mind. What are a few tactical opportunities that could come, in the fixed income space. We hear all about the tactical opportunities in the equity markets. So, drawing on the similar lines, if one has to look at any tactical opportunities, what that could be currently right now, because with so much of data flowing, with so much of what do I say, diversity of decisions, the tactical opportunities often presents itself. So, what's your take on it?
Right now, investment and tactical in an interest rate cycle, I would say that the longer makes the absolute sense. Again, you have to keep monitoring the yield curve, that how it is moving. If you are an active investor, you keep monitoring that on the GSEC and the corporate bond side. So if you see post before March, there the corporate bond yield curve was inverted. There was an opportunity over there that has flattened now. There is still an opportunity over there, but there is a portion of the opportunity that you have missed. Likewise, if we see on the longer duration, we have seen that the spreads compressed to 20 basis points, and now it has again widened to 45 basis points, 45 to 50, depending on the security. So there is a play of the tactical play over there also. So if you are an active investor, you need to see that which part of the yield curve is moving and how it is moving, and where you want to invest. But if you are an investor who wants to play out the cycle entirely, then you invest in a category where you know that it is eventually going to play out. So something like a corporate bond would be a shorter play, because you have to keep moving when the yield curve plays out. But something like a long duration would be a long term play till the interest rate cycle, shifts its stance and then it reverses its stance.
Right. So, Kruti, we have a question here by Mr. Aman Jain. Debt as a percentage of GDP for us is around 130%. And due to this, is it possible for them to maintain the currency reserve status? Other countries are doing net settlement transaction, and it may be possible that gold, which is being used by China as well for net trade settlement against the US reserve status, would that get declined? So in net, I think the question evolves around that, what's the current currency status is one have to see, and what about, the accumulation of gold by central banks that we are seeing right now, what that status could go going forward.
So there is a lot of chatter about the reserve currency and the status of the reserve currency. Rightly so, because it's become a little more divided world than it used to be before. But one needs to think about a few factors before considering that whether that status is declining or there is a replacement of the status. Now, US as an economy has gained the reserve currency status back when UK decided to let go that status. Initially, it started with both of them with underlying, gold reserves that they had. Then they decided that UK cannot keep up with it, the pound cannot keep up with it. But US was strongest at that point of time, and they decided that the USD against the gold would be pegged at $35 per the gold, 100 grams of gold that would be there. That changed eventually because the economy started growing much faster, and the printing started happening much faster, the trade was happening in USD much faster, so the pegging was let go. But since then, what we have to see is that US is an open economy, and what has led its reserve currency is the openness, the regulation, and the free trade that has been available in the USD at any point of time. It's never been an effort to control any dynamic in the US market, whether it is the equity market, whether it is a debt market, or whether it is a currency market. There has always been a free trade available for the investors. So therefore, you have to see that the size that is given to the economy and the freeness that is given to the economy, is there a number two that is available right now? There is, if we speak of China, as an investor today, would an investor openly go and accept that, we will invest our money in China, because the data is not available and the currency is pegged to USD? Then how will you go on to making a discovery of the price that it should be offered at, right? So there is, even though there has been a discussion around it, for now, the number two is not ready to take over US as a reserve currency. And when your trades, 80% plus of the trades happen in USD, there is no other alternative that is there. The second alternative is Eurozone, but Eurozone is not, it does not provide the size that US provides. And plus the regulations that are much more stringent when it comes to trading with the Eurozone compared to what it is with US, that becomes a little more difficult to make it the size of the US. US is a capitalist country, and there is no other economy which is offering the freedom and transparency and regulations as much as US is offering right now.
Right. So we have another question by Mr. Akshay Joshi. So should one invest in long duration funds for long term till next cycle of rate cut, or should exit when interest rates are at the bottom?
So there are two ways that you can play a long duration. One is that you can play the interest rate cycle. That would be the tactical investment that you would do. But if you are a long-term investor and looking at investing in fixed income, then you have to invest in India story. When we say India story, that means that today what rates you are being offered, maybe 5 years down the line, as the GDP size increases, you would not be offered the same rates. That typically happens as the GDP size increases, and as you move towards increasing the GDP size, your interest rates go down by that quantum. We've seen that happening with US. We've seen that happening with China. There are other emerging economies that, the same trend has been taken. There is no debate about why India would not fall into the same path. So eventually, if you want to stay invested in this space and you want to get the maximum benefit of it, then you should stay invested for the longer time and be invested in the India story. But if you are an active investor, then you can play on the interest rate cycle also.
Sure. So another question we have by Mr. Anup Maheshwari. For a 6 to 8 months period, which category could be looked at? And what has been development in the yield and liquidity situation for shorter duration in March and where it is now?
For 6 to 8 months, again, the categories that are available is wide, depending on the investor's interest, right from the short duration fund, which is a essentially close to 3 year fund, to banking PSU, to corporate bond, to long duration. You can look at any category that you would like to invest into. All would, play out in next 6 to 8 months. On the liquidity front, from March till now, we have gone surplus. We are expecting that once the RBI dividend comes in into the play, the surplus would move more closer to 2 lakh crores, which is close to 1.4, 1.5 right now. The aim is that, you get the RBI's aim is to get it closer to the 1% of the NDTL, that is banks deposits and liabilities. We have hit somewhere 0.5%. There is more to go. That's a clear indication that there would be more accommodation that will be there into the system. The only Obviously the short term rates would play out, but again we are saying 6 to 8 months, because if the short term rates are to play out, the yield would go down, but the benefit would be to the longer end of the curve also. And because your duration is higher in the longer end of the curve, you benefit much more than you would benefit in the shorter end of the curve. If you are an investor for, let's say, up to 3 months, then you go for the categories of the short period of the funds like ultra, low duration, or money market. You can look at these categories.
Right. So there's another question by Mr. Aman Jain. As US is basically the service sector economy, same like India, since other countries grow, especially China, so is what prompted US to ask for protection money, or what is called the tariff, which has been imposed by the US on other countries?
Um, I don't think that is the thought process of US imposing tariffs, because
Yeah.
essentially what US has imposed tariff is because they want to go towards being manufacturing, and the consistent point that has been pointed out is that we are at the trade deficit. So again, you have to see that they are saying that we are at the trade deficit on goods with the other economies, and that is something that has hit this regime that we are importing everything, we are not exporting everything. Maybe what they missed out on seeing that because they are importing everything, the eventual investments, the services and everything is flowing back into the economy. That is what generally happens when an economy develops, right? You start outsourcing the smaller jobs to the other economy, and you eventually take up on more important jobs like innovation, development, and so on and so forth, which US has been doing so far. But I guess the goods trade deficit has hit them hard, or at least this regime there, it has hit them hard, and that is what they're trying to get back into the country, or maybe change the world order and not be concentrated on one economy.
Right. So there's another question by anonymous attendee that, if one has to ask you that, to make a or to build a fixed income portfolio through mutual funds, what all would you, in what percentages would you be including at this point in time? So basically your understanding of, mutual fund categories that could be looked at this point in time. While I would actually like to tell investors that, there's no one answer to this because, the risk, the investment horizon would differ for everyone. But let's hear it out from Kruti's perspective that, what would be her take on it. Not necessarily that could be the right answer for every set of investors.
So, yeah, like every investor's needs and risk appetite is different. But if I have to build on my portfolio and I know that, I have next 6 to 8 months and my risk appetite is higher, assuming that my risk appetite is higher, I would go into a mix of maybe short-term fund, a corporate bond fund, and a major allocation to a long duration fund at this point of time.
Right. So, there are actually a lot of questions looking at the geopolitical scenario that, where could the yields go? Looking, say that, there's sort of a geopolitical chaotic situation in India or, in abroad. So, would you like to answer this question? I know it's a little political wise. Yeah.
Uh, so the information, we can only depend on the information which has been given to us. And when we say on the domestic geopolitical, we expected that there would be something that would eventually, there would be a retaliation. But we have to also give the credit to this government that they understood that the retaliation has to be where it's balancing the other factors also, and that is what they have done. They have not attacked the borders, they have not gone into any military camps, they have not attacked any of the civilians or anything. All that they have done is they have spotted on the targets where where there could be activity. That's what the media is reporting right now, that they have spotted the terror developments that were happening, and precisely those are the spots that they have uh, taken down. The operation went on for only 25 minutes, not more than that. And one wonderful thing that if you have read through these developments is that at no point of time any of the Indian Army or Air Force or whatsoever crossed the line of control. So this all has been done within the bounds of the line of control, not going anywhere closer to or breaching any of the limits that could be that could raise questions on us. Uh, could there be escalation? Well, obviously,
More impact on yields
yeah.
and on the
So,
markets. Yeah.
yeah. So, could there be escalation or impact on the market?
Yeah.
When this development happened today morning, we expected that markets would be much more in the sell-off. There
Mm.
would be more, impact on the yield. On the contrary, at least fixed income markets have uh, positively responded to this event, saying that this is something on the expected lines and we don't see much of the damage that has happened from here. So it's positively received by the market rather than anticipating the worst that's to come.
Right. While there's no clear impact of the whole situation and no clear answer also. But yields and markets are more driven by at least in that situation, what the current scenarios are in the markets other than the geopolitical ones. So, right, there's another follow-up question to the investing for short term that you had it answered. So, in the 6 to 8 month time period, can there be expected any M2M gains in the corporate bond segment?
Precisely why we are saying that this segment is attractive,
Right,
because the fixed income as a whole is in a very sweet spot, and the main play rather than accrual would be M2M in this period. So there would be M2M gains in
right.
next 6 to 8 months.
Sure. So, with this, Kruti, any concluding remarks you have on the fixed income outlook side, and anything on the fund recommendation side you have for our viewers?
So we pretty much covered everything in detail so far, but to just reiterate, India remains in a very, very sweet spot right now, and with all the support and the diplomatic relations that we are forming, the stability is likely to continue. Yesterday, we also signed a deal with UK. So we are getting all those support also from the external, which will help us maintain the stability on all the fronts, which is why we see that the markets would also develop in a stable way. And once as an economy we are ensured of that stability, the other aspect is to, like, go down on the interest rate to boost this economy, and that is what precisely we are seeing, that MPC is setting up the stage and communicating. So the outlook remains very positive for the fixed income, and like we've mentioned before, across categories there is a positive momentum that would be there, but to for the maximum benefit, a tenure would be a good call to take for the investor.
Right. So, thank you, Kruti, and thank you, viewers, for joining us. For regular updates on the fixed income markets, you can visit our website or our social media handles by the name of Mirae Asset Mutual Fund. So, thank you, Kruti. Have a nice day. Yeah.
Thank you, Tanya. Thank you, everyone.